Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 18th of January. I'm Daniel Lam, your host for the podcast. I'm very excited about tonight. For the first time ever, I will be watching at the stadium a basketball match in the Hong Kong-China Local Basketball League. I will be bringing my 4.5-year-old boy. Lately, he's been getting a bit upset when his classmates tackled him during his football and basketball classes, and I believe it is time to show him the nature of competitive sport. Well, global fund flow is also like a competitive sport. While the weakness in Chinese assets persists, hurt by yesterday's set of data, Indian assets continue to receive attention from investors. Now, in previous podcasts, we highlighted how India is enjoying structural tailwind from favorable demographics, i.e., 70% of its population is in the working bracket, enabling fast growth in middle-class consumption. Valuation of Indian equities is nearly as expensive as those in the US, but its earnings growth remains decent, and the Indian Nifty index is making higher highs and higher lows. Now, one key macro development in India is the falling core inflation figure, i.e. CPI ex food, beverages, fuel, and light. And that is going below 4% for the first time since March 2020. And this is mainly due to stable commodity prices and well-anchored household inflation expectations. A below 4% core CPI provides a cushion to absorb future food price shocks and increases the likelihood of headline CPI staying within the Monetary Policy Committee's mandated target of 4% plus or minus 2%. In the meantime, we expect India's economic growth to stay above emerging market peers this year. Resilient domestic demand, supportive policies, and high capex are factors underpinning the positive outlook. So this near Goldilocks scenario supports Indian equities. It also lends tailwinds to Indian local currency bonds as well. So they offer an attractive yield of around 7.2%, higher than the 6.3% yield offered by EM local currency bonds. The falling core inflation leads to possibilities of rate cuts later this year, which is favorable for bonds, and the recent inclusion of INR bonds in global bond indices is expected to be an additional tailwind for Indian bonds, given that foreign investor participation has been limited in India's large and liquid bond market. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.